I had to learn the lingo of the commercial and the brokers, how the brokers spoke, right? So that they can respect me and that they can give me deals. This is Martin Perdomo, the Elite Strategist, and you're listening to Latinos in Real Estate Investing podcast. In this episode here today, I want to just drop in here and share with you the real estate lingo you need to learn in order to sound and be a professional in this game. You show up to one of our meetups, or you show up to a meetup and you can understand and you can have a discussion or with another investor, it gives you more credibility to be able to them sending you a deal, a wholesaler, a realtor giving you a deal. It just improves your chances of you getting a deal, okay? So I got a list of things that I'm gonna share with you here today, and I'm gonna give you some of my experience with this stuff. By the way, I'm gonna drop in the show notes in this video, I'm gonna put the PDF. You guys will have it available to you as a reference guide because this is valuable information for you. The first one I have on my list is one that you guys probably may or may not know, and it's ARV. And the ARV is most commonly used in the flipper world. Most flippers use that word as a flipper. The ARV is the after repair value. CRE, street cred, right? CRE, commercial real estate. So when you're talking to someone or you see a listing and it says CRE, that basically means commercial real estate. GRM, the gross rent multiplier. Another term commonly used among the lending space. When I was a mortgage broker, we used to use this every day. Actually still use it now. Actually, I was having a conversation with my lender this morning, and we're taking down a 3-unit for $80,000. And I said, you know, we're buying this portfolio, we're buying this 3-unit and this other asset, this other 8-unit. I don't necessarily love the 3-unit. The numbers of the 3 units are not that great, but they come together. So that particular loan for the 3-unit is going to be an LTV loan versus an LTC loan. LTV just simply means loan to value. So if you have a $100,000 value and you're going to take out and you're going to finance $70,000, that's a 70% LTV. Simple math, right? The next one is MAO. Again, another term used largely in the flipper world, maximum allowable offer, right? And the formula for that simply, in most cases, is a 70% rule. The 70% rule is the rule that the lenders make, the hard money lenders make, and they want to see 30% in equity. Your ARV, less 30%, that leaves you 70. Rehab costs, less closing costs and holding costs, less wholesale fee, that's your maximum allowable offer. So that leaves up the top a 30% spread for you to make profit. That formula is very important because this is what the lenders use. In the book, Richest Man in Babylon, there's a quote in there that says, the golden rule. He who has the gold makes the rule. In our space in real estate, he who has the money makes the rules. So the lender makes the rules. They have all the capital, right? They make the rules. They say, this is the formula we want you to follow. Your job is to go find deals that meet their criteria. I'm gonna give you a bonus here real quick. So in real estate, there's a pyramid. Think of a pyramid. And at the bottom of that pyramid, you have wholesalers. They're locking up contracts and they're selling contracts. Above them, you have flippers. Flippers, another job. It's still an active job, right? I'm still a flipper. I enjoy it. And that's what keeps the lights on. That's what keeps the business and the cash flow, the big cash flow going here in the business. Flipping is the next ladder up. The next step up from there is where wealth is really created, is in the buy and hold. So the triangle gets smaller. And at the tip of the spear, you have the money lender. The tip of our industry is those that have the money. If you eventually make it to the point where you're lending money, you're at the top of the spear because those that have the money make the rules. RTO, most commonly known as rent to own. So whenever you see that lingo, RTO, that simply means rent to own. REI, right? Strasbourg REI, Strasbourg Real Estate Investors Group. REI, Real Estate Investor. Proof of funds, POF. So you make an offer to a realtor and you'll hear a realtor tell you that you have a POF. SFH, single family home. Single family home, SFH, single family home, or SFR, more commonly known, single family residence. Either way, they mean the same thing. The MLS, that's the multiple listing service. For us right now as investors, I have a saying here in my company. If the deal hit the MLS, it no longer is a deal. The market at this point, as I record this today, it is January 19th, 2022. The market is very hot here in our area, and we have very little inventory. So when it hits the market, when it hits the public market, when it hits the MLS, we're competing with stupid. It's not a deal anymore. And I mean that respectfully. When I say stupid, it's just people that don't understand the formula I just gave you. They're overpaying. By the way, that was me. In 2007, I overpaid $100,000 on my first duplex. I was $100,000 in the water within a year of my first investment. So I've been there, and that property was on the MLS. I no longer buy on the MLS unless the numbers make sense and the math adds up. FMV, fair market value. LLC, right, a limited liability corporation. You're gonna hear that a lot in real estate investing space, right? As a professional investor, you shouldn't be buying any properties in your name unless you're house hacking and you're just getting started. And me personally, if I had to do it over again, from when I bought my very first house at 21, I would have bought a quad. I would have lived in one, rented 3, cash flowed, got an FHA, waited a year, because the FHA rule says wait a year, moved someplace else, 3% down again, got another FHA. Within 2 years, 3 years, I would have had 8 to 12 units. And that's how you house hack. If you're looking to get in this game, that's the easiest way, the fastest way, the lowest hanging fruit. Get a duplex, get a triplex, get a quad, get a mother and daughter, and Airbnb the bottom. Make it an asset. Make your properties an asset. ROI, return on investment. NOI, net operating income. And this is simply, so gross income less expenses equals net operating income. When you're doing the numbers or you're trying to make an offer on a multifamily, you take the gross revenue, you take the known expenses, you minus it, your net, that number at the bottom is your net operating income. You then take that and divide it by your trading cap rate, and that's your assessed value, and that should be more or less what that asset is worth based on income. Cap rate is a whole other discussion. I got some videos on YouTube. Check out my YouTube video. I thoroughly explained that there. BPO, broker price opinion. REO, real estate owned. So that's used really a lot in the lending space and in the investor space as well. I mean, in both areas. BRRRR, you'll hear this. It's very common in our space. The BRRRR method. That simply means buy the property, you rehab it, you rent it, you refinance it, and you repeat the process again. That's the BRRRR method, okay? But the key to the BRRRR method, guys, the key to this game is to ensure that you have a lender lined up and that you know their rules, because remember what I said, whoever makes the money makes the rules. I have a video I did on YouTube where I give all of the step-by-steps, I give a bunch of freebies, and I give away how to vet a lender for your BRRRR. So one of the things is you want to know if they have a seasoning period or not. That's important. Seasoning is how long you have to own it before they refi it. The next one is DYOR. Do your own research, right? Do your own due diligence. DYOR. Do your own research. Next one is REIA, Real Estate Investors Association. Heloc. We throw that word around loosely. Heloc. A Heloc is a home equity line of credit. That's when you have a property, your personal, the house you live, you've built equity over years, and now you can go to the bank and say, hey, I want an equity line, and they'll say, okay, so you owe now $60,000 on this mortgage. The property is worth $100. Your balance is $60. So we'll give you a checkbook. You can write checks up to $40,000, right? Because that's your equity. And if you're smart and you've built some equity, you can take that money, go buy a property, BRRRR, get the money, pay it back, and you can create wealth with that. If you know how to do it, guys. But you gotta have the right education. You gotta know this stuff. If you know how to do it, you can turn that 80 into 100, into 200. Before you know it, you have $500,000 in equity and cash flowing assets all over the place. If you learn how to do that, if you learn how to use money, and if you know how to use other people's money. The next one is DSCR, which is a debt service coverage ratio. You need to learn that when you BRRRR. That NOI, most banks want it to be 1.25, 1.20. So if your mortgage is $1,000, right? They want to see a net income of $1,200 minimum for that loan, for you to qualify for that loan. That's your DSCR. 20% more than what your monthly, what your mortgage, either you calculate it monthly or annually, is the average, about 1.2. I'm gonna give you a little hint here. One of the things I do when I'm underwriting a deal, if the bank's DSCR is 1.2, I like for my DSCRs when I underwrite them to be at 1.4, 1.5. And my reason behind that is if the bank is comfortable at a 1.2 DSCR and they have hundreds, thousands of loans out there and they have the experience, they have the data, right? The 1.2 DSCR is what keeps us safe. So hint, for me, what I've done is say, okay, if that's what they want, then I want to be at 1.5 because I'm going to be even more conservative. And if I get a DSCR at 1.5 and I show it to a lender, lender's going to be jumping all over that. It's a strong deal. It meets their minimum requirements and everyone's happy. I'm more conservative and I'm making money and you're making money and everyone's making money. And then lastly is triple N, which is a triple net lease. And basically a triple net lease simply means that it's more commonly known in a commercial building where you got a bunch of tenants. They got to pay part of their, apart from their rent, they pay for part of the taxes, part of the garbage, and just all of these things are tacked on to the commercial tenants, and the owner doesn't have to necessarily pay or eat up those expenses. That's what a triple net lease is. Guys, I so truly appreciate you guys listening and watching this video. I really appreciate it. If you guys shared this content, if you found value, leave us a positive review in the bottom. And if you're watching us on YouTube, give us a thumbs up and share this if you think you found this valuable. In addition to that, guys, I'm gonna leave you this list. I'm gonna put it in a PDF format for you to keep as a reference guide. Appreciate you guys. Thank you for listening. Thank you for watching. I'm truly grateful for your time. Peace out.